Hello and welcome back. Apologies to those who have been waiting for new episodes on this channel. We were busy working on a few strategies, and in today's episode, we will be commencing a feature series on this channel that will demonstrate how you can deploy simple options trading strategies to generate cash flow of a small trading account value. And we will start with the ticker symbol LABU, and we'll start by selling puts. All right, let's get it. The idea is to help you to appreciate the fact that you can spend a few minutes each week to research option trading strategies that you can execute on without the need to stare at your computer screen for hours each day, but still be able to generate a significant cash flow that should get you to a point where the income from your trades pay for a decent standard of living. This means that you will start with a small amount. You would probably be looking at a maximum of 1 hour each week in researching your strategy that you're going to execute. It needs to be said that this is not a get rich quick scheme. You're required to put in the work, and so this is not something you're going to do and then tomorrow you'll be a millionaire. There is a need for consistency and a willingness to learn what will work or will not work. But if you are consistent and you want to learn, you will eventually get to a final destination where you're generating enough cash flow to take care of your necessary living expenses. Before we proceed, let's look at a few critical definitions. So, what are options? Options are contracts that allow the buyer of such contracts the right, but not the obligation, to exercise a buy or sell action on the underlying asset on or before the expiration of the options contract. Options contracts involve multiples of 100 units of the underlying asset, and there are two main types of options contracts: the call option and the put option. Let's illustrate a call option with a fictional asset called ticker symbol XYZ. So assuming ticker symbol XYZ is trading on the stock exchange and you have bought 100 units of XYZ, and you bought those units of XYZ at $1 per share. Now, you can decide to hold ticker symbol XYZ and hope that the value will appreciate and you'll be able to sell your 100 units at a higher price and make a profit. Or if XYZ pays dividend, you can decide to also hold it in perpetuity for as long as they pay dividend. With options, however, you can increase the potential to generate extra cash flow for yourself. To illustrate, assuming that you could trade options on ticker symbol XYZ in the options chain, and the options chain here is the market where options are traded. So let's say you could sell a 30-day covered call at a strike price of $1.50 per share, and you could receive 10 cents in premium per share. This means that the buyer of the call that you sell is given the right, but not the obligation, to buy the shares from you within the next 30 days at $1.50. And for getting such a right, the buyer of the call will pay you 10 cents per share. So why would someone in their right mind give you 10 cents per share on a stock that you bought for $1 per share? Well, the buyer is anticipating that the price of XYZ will rise above the $1.50, and if that happens, they can then buy these shares from you at a price that will be lower than the market price. You, on the other hand, are giving up the potential additional profit that could come if the price goes above the $1.50 mark. but you don't mind because you bought the shares at $1 and you would be making a total of 50 cents in profit that comes from appreciation of the shares to $1.50 and additional 10 cents that you received for selling the call. This means that in total, you will receive a profit of 60 cents per share on or before the expiration of the options contract if the price of ticker symbol XYZ goes above $1.50. The flip side to that coin is that the value of the shares stays below the $1.50 by day 30. In this case, you still get to pocket the 10 cents per share that you were paid as a premium at the start of the contract, and you still get to keep your 100 units of XYZ shares, as it doesn't make sense for the buyer of the call options to exercise their right to buy those shares at $1.50 when they can buy the shares for a lower price in the open market. And what that means for you is you can start another cycle of selling call options contract for another 30-day period and generate another extra cash flow. So I hope you can see how call options can be used to generate extra cash flow. So let's talk about put options, or more specifically, cash secured puts. A cash secured put contract offers the buyer of such a contract the right, but not the obligation, to sell the underlying asset at an agreed strike price on or before the expiration of the contract. So let's go back again to the illustration of ticker symbol XYZ. Imagine that the value of ticker symbol XYZ has risen to $1.55 and you feel like a good price for you to buy the stock, if it was to come down, would be $1 per share. You could sell a put contract on the options chain, and let's assume that the premium on the $1 strike for the put option that expires in 30 days is trading at 5 cents per share. This means that as the seller of the put contract, you are committing to buying ticker symbol XYZ at $1 per share if the price drops below that $1 mark on or before the expiration of the 30-day put contract. It also means that the buyer of this put contract owns 100 units of XYZ that they anticipate will fall in value within the 30-day period, and they are hedging any further losses by getting you to commit to buy the shares at $1 per share. What could happen? Scenario number one is that the price of XYZ drops below the $1 mark. You need to pay $100 for 100 units of the shares. However, your actual cost, if we don't factor fees, is the $1 per share that you're paying minus the 5 cents per share that you received as premium for selling the put, which translates to 95 cents per share. If the price of the shares do not drop below the $1 mark at the end of the put contract period, then the contract will expire worthless, as it won't make sense for the buyer of the put contract to exercise their right to sell you the shares at $1 per share when they can sell the shares in the open market for a higher price. What this means is that you get to pocket the 5 cents per share premium that you were paid at the beginning of the contract, and that means that you have a profit on your $100 collateral of 5% or $5 if we don't calculate fees, and your $100 collateral will be returned to you, which means you can sell another put on ticker symbol XYZ or any other share that you deem appropriate. So now you can see how options can be a valuable tool to generate extra cash flow for you instead of just simply buying and holding or selling shares in the open market. Of course, if you're unsure about anything that has been discussed so far, please feel free to leave your question in the comment section and we'll be sure to respond to your questions. And if you haven't done so already, please hit that subscribe button and hit the notification bell so that you are up to date on the educational content that I put up on this channel. Right, while this next section of the video is not to be construed as financial advice, we want to demonstrate how you can deploy the put options strategy to generate some cash flow that will either result in your buying shares at a discounted price or putting some profit into your pocket. So the ticker symbol we're looking at here is ticker symbol LABU. And if you look at ETF.com, it says that LABU is a daily 3 times leverage bet on equal weighted index of US biotech stocks. In other words, the people that are running this ETF are day trading some biotech and pharma stocks, and they close their positions daily, and they're also borrowing up to 3 times their allocated funds to trade these stocks. As you will see from Yahoo Finance, ticker symbol LABU has dropped in value since the beginning of 2022, but it has been trading between the $6 and the $9.20 mark since October 2022. So we can say that this ETF has been trading sideways. What is interesting, however, are the prices of the options for this ticker symbol. So if we go to Tastyworks, we will see that you can sell the $6.5 call on ticker symbol LABU that will expire in 4 days for 12 cents per share. If we take a look at the analysis that is shown here, we will see that ticker symbol LABU is trading at $7.34. We talked about selling the put of the strike price of $6.50, and for that we receive a premium of 12 cents per share. And the number of contracts we're looking at is 1. This means that our collateral is $650, which is the strike price of $6.50 multiplied by 100 units of shares. If we assume that Tastyworks will take 13 cents in fees, and we're going to be paid 12 cents per share, so that would be $12 minus the 13 cents, which translates to a net margin of $11.87. This will be a return on the $650 investment of about 1.8%, almost 2%, and the days to expiration for the options contract is 4 days. If you analyze this 1.8% return on a 4-day period for a 1-year period, it means that you will more than double your $650 investment over a 1-year period if you were able to achieve a 1.8% return every 4 days. That means that if you started with a $650 collateral, by the end of 1 year, you would have grown your account size to $1,040. Now imagine if you had more than $650 and you were able to grow your account size to almost 200% within a 1-year period. I'll let you do the maths and decide what kind of value you can get. Of course, it has to be said that this 1.8% return is not a guaranteed return every 4 days. Things could go south. So, for example, like we mentioned, you could end up having to buy ticker symbol LABU at that $6.50 mark. And if that happens, then of course you can sell the covered call strategy. So what we invite you to do is to stay tuned on this channel. We will be executing this trade later today, and we will keep you posted later in the week on what happened after the expiration period of the contract and how much we were able to generate in profit. And then next week we will review another potential trade and see what additional profit we can generate for ourselves or discounts. Of course, you want to check us out on the different social feeds. And if you know anyone who will benefit from watching this video, please do us and do them a favor and share this video on your social feeds. Thank you and see you on the next episode.